There is a critical investment distinction between losing money and having investments that are worth less when markets go down. Risk of loss versus risk of volatility. You have three people that each have $1 million and want to generate a positive return in cash flow and do not need a return of their capital for 10 years. The first has a business that sells salads. The second owns a building that is residential real estate. And the final owns a tremendously diversified portfolio of worldwide equities, REITs, bonds, and other investments. A recession happens. Please tell me which of the following loses their money. The salad business. The FDA comes out with data that shows salads kill people. What happens to their business? It is nearly a total loss, except maybe the equipment. 2. The rental real estate building has been rezoned for commercial business only, and the building needs to be retrofit for $300,000, and the investor does not have it. People that own similar buildings say they have offices for rent, and due to the recession, people are not renting. The final person owns and loans to thousands of companies and governments around the world, also known as investing. During the recession and the market panic, the equities and REITs go down in value. The final person continues to receive interest and dividends, but the value of their assets are worth $200,000 less than they were just a year ago. So now which one has irrevocably lost money? I would argue only the first two have lost money, although the third's investments are currently valued less than last year. As long as the world markets do not go bankrupt, it is a temporary state of affairs. He or she will continue to receive dividends and interest, and most likely the investments will come back. They'll cycle back to the upside if all investments are continued to be held. Actually, it may be an opportunity for the investor to rebalance some of the bonds, sell them, and buy more equities. And when the market roars back, it will be even more profitable. So remember, volatility cuts both ways, up and down. So please do not use the phrase, "I lost money in the market," and replace that with the current value of my investments are worth less. But as long as the world markets recover, so will my investments. Of course, that's only if you're diversified and only if you hold on. One could argue that if the third needs the money, then a loss would be realized, but we recommend only putting a percentage of investments that you do not need for 7 to 10 years in risk assets that have great volatility. Another correction will come, and it's very difficult to time when that will happen. Asset allocation and diversification and sticking with your plan are the keys to enjoying the recovery after the correction. Active mutual fund managers may have to sell in a market downturn to pay off investors, or they themselves may panic. So investing in index-based funds and ETFs gives us control. I'm Kevin Gormley, a CPA that does financial planning. Please understand, volatility is a part of investing. You can lose money in investments, but if you fully diversify and the markets come back, it will be just a painful memory. Thank you.